Many people think that the news moves the price. In fact, what you'll find is the price has already moved and news is just an explanation. There is a difference between signal and noise inside the news. Signal is really important to understand and noise is really important to filter out. In this video, I'm going to literally reveal the secrets that the institutions have known for hundreds of years, but retail investors and traders wouldn't even think to do. We're going to look at intercorrelation, interconnection, and then finally structure. And I'll share a Pepe trade with you to show you that you can make money no matter what direction a price chart is going by going long at spot. Let's run the numbers. Before we get into the Institutional Secrets Masterclass, I want to give you some very important background. In 2016, 3 months after my sister died of a very horrible cancer, I was diagnosed with brain cancer and given 1 month to live, and 3 months until my body died. This profoundly changed how I looked at the world. I had spent many decades inside financial markets. I wanted to make sure that people knew the institutional secrets, so I started the YouTube channel CryptoTradingKS. My focus was to share knowledge. I also wanted to strengthen the love between family members and give them a way of coping with loss, stress, and anxiety. I wanted people to be more of a financial blessing to themselves and those they loved. Financial markets can be really difficult to understand if you don't have a background inside finance. And even if you do have a background inside finance, they can still be really difficult to understand. I want to help you to gain an institutional grade edge inside financial markets. Your family's financial future literally depends on this knowledge. One thing that I wanted to raise, if you haven't done so already, please download the free cheat sheet from CTKSmethod.org. It is definitely your key to mastering price action. Cheat sheet gives you a really powerful way to separate signal versus noise in the news. It's composed of 7 rows. Rows 1 and 2 measure risk on or risk off behavior. These are particularly important to keep your eye on. We're also going to use 3-dimensional risk management and CTKS paths today. You learn how to draw those through Level 2 standard certification, but I'm going to take you through selective charts throughout the cheat sheet and show you the paths. What you're going to find is that row 1 and row 2 will directly impact what happens inside row 3, the major market indices. And of course, the stocks just pull their direction and momentum from row 3. Investors are investors and traders are traders across all financial markets, be it Forex, commodities, crypto, the stock market, it doesn't matter. So when you understand what's happening with sentiment across row 3, that feeds sentiment into row 5, the crypto market. But as the crypto market is really tiny comparative to the stock market, what happens is sentiment can sour or sentiment can improve very quickly before the major market indices and stocks are hit. That's why the canary inside the financial coal mine is definitely the crypto market. Now, inside the profiting course, I explained that row 1 and row 2, these are all like drivers on the bus of risk, and potentially you can get one or more drivers just sitting up next to each other to drive risk on or risk off behavior. Now, recently it's been the VIX in full control of the bus, and I believe this is going to continue to be the case over the coming weeks. So understanding how the VIX is moving and how it's impacting all of these different rows is vitally important. The VIX is the fear gauge of the main market, and what you can see here, these different colored paths are called CTKS paths. They come from Level 2 standard certification, and I draw these up each and every month inside the CTKS Method service. Now I'm sharing them here with you to help you to understand how price is moving and why. This is pure signal. Now you might say, what has the VIX got to do with, for example, Bitcoin, crypto, or maybe commodities such as gold? And what's it got to do with Tesla, MicroStrategy, Apple, Nvidia? The answer: everything. These particular price paths are drawn with an understanding of CTKS structure. They are not random lines, and they are meant to represent normalized price action. When we get non-normalized price action, we see the price of the chart will significantly vary from the upper boundary of the monthly estimate. This is something you want to keep in mind. It's kind of like a pro tip. When we look at the VIX, you can see the VIX actually spiked up. It maximized its upward momentum on the 11th. And what was the minimum on the 25th? The 11 and 25 numbers are really important for you to keep in mind. What happened to the DXY? As the VIX spiked up on the 11th, we saw the DXY absolutely spike down and just come underneath that normalized negative price path. But normalization is a process where price reverts to the normalized price path, and we've seen this over the years. This is another important signal to be aware of. Just because the price is down here, for example around the 11th, the price path was here, and these price paths are drawn at the absolute start of the month and not changed. Remember the 11th. What we see is the DXY bottomed on the 11th, came up to around the 25th, went plus 1 day and started to come down. Now, what does this mean to you? If you see the DXY continuously fall, it's pointing to upward pressure in the VIX. Don't forget, the VIX is driving everything. Now, how does the VIX work? Basically, if the VIX goes up, your price of whatever chart you're in, maybe with the exception of gold, but we'll get to that later, is coming down. So VIX up, price down. VIX down, price up. You can make a lot of money as the VIX is spiking up and down all over the place, but not as an investor. As a trader you can. That's why you should invest and also trade. Trading helps you with timing, investing helps you with just hanging on for dear life. And to invest, you can't invest emotionally. For example, the ultimate gold standard in investing is when the VIX is spiking up, you're adding to all your positions. And what you'll frequently find is it doesn't go that way. People add to their positions as price goes green for their investing account. This is absolutely getting on the wrong side of the percentage. Later on in the video, I'll explain what I did with Pepe in the past 24 hours. And I'll show you how getting on the right side of the percentage can make you a great deal of money. Looking across another row 1, dollar yen, we can see that the negative normalized price path, dollar yen has been coming up. Remember the 11th and remember the 25th. What are we seeing? Dollar yen bottomed on the 11th, and we've seen the 25th, it started to come down, but a couple of days of plus behavior. So what this means is even if the VIX starts to bottom out or it starts to top out, you could get plus 1 or 2 days of variance inside your chart. Very important to understand. Now, what does this also mean? If the VIX is set to spike, we would expect dollar yen to decay. This is a stacking of probabilities, something that I talk about a lot. And what you will find throughout the months, structure is incredibly important. For example, last month, if we predicted that dollar yen would end up here, a lot of people would say, that's pretty interesting. How would you know? The answer is structure. The US 2-year yield is very important to understand, and last month we saw it go quite negative. It literally plummeted down. Now when we look at the 11th, the 2-year came down, bottomed. What about the 25th? We saw a bit of a spike up, but it's certainly coming down now. So what does that mean? If we see the US 2-year yield continuing to decline, like it's been doing when the VIX spikes up, that's a stacked probability that the VIX is increasing. It's a confirmation signal. Now you might say, what the heck has this got to do with my random meme coin? Say, for example, Pepe, or it could be anything else that you're trading. Solana, XRP, ADA, Bitcoin, doesn't matter. or Nvidia, MicroStrategy, whatever your charts are. If the VIX is going up, guess what? The market is coming down. You must gain as many signals as you possibly can to understand where price could go. And if you don't, it's like akin to guessing, and if you're guessing, you're gambling. Instead, you want to professionally gamble, you want to count the cards instead. This is akin to counting cards. Let's again look at 11 and 25 on US oil. What do we see with US oil here? US oil pretty much bottomed right there on the 11th as the VIX topped out and started to come down. What about the 25th? We saw a bit of a rally from the VIX topping to the VIX bottoming on the 25th, and that brought the price of oil up. A lot of people say, oh no, it's supply concerns, it's all of that. But the truth is, it's actually intercorrelation and interconnection. Institutions look between the charts, they look to stack probabilities. Exactly what I'm doing here. Institutions don't read the news, they write the news. Now have a look at this. We're starting to see a bit of negative momentum. If we get a confirmation signal that oil starts to drop, that means that the VIX is coming up. So keep your eye on this particular chart as well. For many, this is a very different way to look at the markets. Typically, all the row ones move together and confirm each other, but we've seen something really strange. The VIX moves in one direction and the DXY and all these other components on row 1 move in the opposite direction. This is an economy-wide shock that's occurring at the current time. When we get this disalignment, and we would imagine that the VIX is now currently moving in directional correlation with the row 2s, but not junk. Economic shocks create these kind of situations inside the market. That's why you want to look at row 1 and row 2 in culmination. Let's have a look at row 2. Remember on the 11th, the VIX topped out, but 2 more days of negative price action inside the markets. This +2 is going to become really important to you as you look through future charts. Remember, it's a gravitational thing, it's not an absolute rule. So as the VIX tops, we saw the junk bond continue to come down for +2 days. Very important. What about what happened on the 25th? There it aligned. So what we've seen is the VIX went up on the 25th and junk decided to get its act together and just align perfectly. But just think, +1 day, 2 days. But keep in mind this +2 days here. The DXY and the euro dollar move in opposite directions to each other, and we've seen the euro actually follow the VIX up. And when we look on the 11th, the euro dollar actually continued to go up. Why was this? A lot of people were saying, for example, with the US policies on tariffs, let's reallocate our funds. Let's pull them out of the DXY or the US dollar currency index, which immediately strengthens the euro dollar. Now make a note, look on the 25th. Very interesting, it's starting to come up again. This is the process of stacking probabilities. A lot of people aren't used to this process, but institutions do it without any hesitation whatsoever. In fact, an institutional grade player will not even look at a chart, will not invest, will not trade until they have actually stacked probabilities. This is the difference between retail and institutional grade thinking. With the Aussie dollar, we note at the 11th, we actually saw the Aussie dollar move in conjunction with the inverted DXY. Remember, the DXY was coming down and bottomed out around that particular time, but the euro just continued to come up. What we've seen is increased strength in non-US currencies. Eventually, these charts will all correlate in with each other, and row 1 and row 2 will resume their normal relationships. But for the current time, it's just not happening. When we look at gold, we can see that last month it followed its normalized positive price path, and this month it's also doing exactly the same thing. A lot of people would say, oh, gold, you could never anticipate where it was going. But with the knowledge of structure, you can. Just popping back to the VIX, we can see the VIX topped out on the 11th and bottomed out on the 25th. So bottom on the 25th, top on the 11th. Let's go back to gold. We can see, unlike the DXY, gold actually came up on the 11th. It staged a little bit of a push up. Now, this is quite a different situation because we know that the VIX topped on the 11th and bottomed on the 25th. Now, what's been happening with this bottoming price action? We've seen a bit of a rally inside gold. Remember, we had the same kind of rally, then it flattened out and retraced. The key to understand is everything is structurally based. These paths are drawn from structure. What actually occurs at this time is dependent on structure, not so much on the VIX. The VIX will give a degree of momentum, but structure is the ultimate arbitrator. And if you've been following the community for some time, you know that gold had a tremendous amount of overhead structural resistance right here, and it started to get above it. That actually goes well for gold. What about silver? Looking at the three-dimensional price paths, we can see that silver is following the normalized positive price path. We also know that on the 11th, the VIX topped out, which coincides to around here. We also know on the 25th, the VIX bottomed out. So we can see there is a degree of correlation, not perfectly by any means, but there is a degree of connection between the VIX and also gold and silver. And gold and silver like to hang around together as well. Last month, we saw copper doing really well at the start of the month. In fact, it went pretty high, but it finished on its normalized price path. We can see copper doing extremely well this month. It's important to understand the process of normalization is just natural. Things normalize. It's often good to look between charts. We know that gold just came up and then started to go flat, and we can see copper actually started to go down and then surged. We're seeing a lot of strength inside the commodities market. So that's the 11th and that's the 25th. Going back to the cheat sheet, what does it actually mean? We can see one thing in terms of the VIX. The VIX is tending to move in directional correlation with these guys. Junk bonds is tending to move in directional correlation with those guys, and these guys always invert each other. This is why when we try to figure out who's driving the bus of risk, it's undoubtedly the VIX. There is no question. But when it comes to stacking probabilities, stack probabilities in this direction and stack probabilities inside this direction. Now, I'll ask you a question to see if you've kind of got it or not. If the VIX spikes up, what do we expect to happen to the DXY, dollar yen, the 2-year, the 10-year, and oil? And if the VIX spikes up, what do we expect to happen to the euro dollar, the Aussie dollar, gold, silver, and copper? So you can see immediately, even if you're really new to this kind of thinking, you're thinking from a stack probabilities perspective. It's very advanced. Now you might say, Ken, why do I need to do that? Well, let's have a look at row 3. Now before we do that, understanding what row 3 actually means. Row 3 is the arbitrator of stock price. If row 3 is coming down, you can bet your bottom dollar the individual stocks, especially the major ones, are coming down as well. If row 3 is green and going up, expect the major stocks to go up as well. What about the interrelationship between row 3 and row 5? They are definitely intercorrelated. If row 3 is going up, we anticipate and expect row 5 will be going up as well. Now, what's the relationship between row 6 and row 7 and row 5? It's fairly straightforward. It's the relationship between row 4 and row 3. It just basically means if Bitcoin and total are going up, expect the crypto market to go up. If the S&P 500, Nasdaq, Dow and Russell are going up, expect the stock market to be going up. Pretty simple stuff, realistically. Now, what causes the stock market to go up and what causes the crypto market to go up? You've got it, row 1 and row 2. That is why they're so important, and that is why you should have the cheat sheet. So you just remind yourself each day to look at it. Many people will trade an ETF on the major indices, never understanding how all of the structure is actually dictating the direction and momentum of these major indices. We can see that the S&P 500 was incredibly negative, but it came back and normalized to its negative price path. What do we know about the 11th? The 11th is where the VIX topped out. What do we know about the 13th? The 13th is where junk bonds bottomed out. Remember this plus 2 days. It is significant to understand. What about the 25th? That's where we know the VIX decided to put in its bottom and start going up. Now, the increase in the VIX has done what exactly to the stock market? It's pulled it down. When you get really good, you should be able to look through charts and consider what the structural levels are on the DXY, the US 10, the US 2, the Euro, the Aussie, gold, silver. I think you get it. You need to look more broadly than just the chart that you're putting money into. That is, if you want to survive in financial markets. It's literally a survival thing. You could think about it this way. It's one thing to make money, it's another thing to keep money. In order to keep money, you must think institutionally. Retail will only drill into one chart and think that chart is somehow utterly independent of market conditions. Any veteran has been there. Everybody understands it. But it doesn't work. What do we see when we look at the Nasdaq? The Nasdaq followed the negative price path for last month, and it's doing so this month. Where did it bottom out? You can see the 11th and the 13th, they're pretty close. In fact, the 11th is more of a signal. So the Nasdaq is following the VIX and the S&P 500 is following junk bonds. But there's a degree of intercorrelation between the two. And what happened on the 25th? We know that the VIX came down and bottomed and started going up. Now the question is, why did the VIX bottom? As people know already inside our community, the VIX had a ton of structural support underneath it around that time, and it just slingshotted up as we would anticipate. Now, what did that do to the Nasdaq? On the 25th, the Nasdaq started to come down. This is not surprising at all to us because we understand intercorrelation and interconnection between different charts. You could, of course, read the news, but it will never give you this institutional grade version of what the markets are actually doing. Looking at the Dow Jones, we saw that the Dow started positive and ended pretty much, well, it didn't do too badly, but it was a bit negative last month. What have we seen? It drew back to the normalized negative price path and then resumed. Where did it draw back? It wasn't the VIX, it was junk bonds. So the Dow is following junk bonds. What about the 25th? It had a little bit of a +1 overshoot, but the gravitational pull is absolute. So just think about it like this. If the VIX is spiking, junk bonds are coming down, the S&P 500 is coming down, the Nasdaq is coming down, the Dow Jones is coming down. What do you think about the stocks that comprise these major indices? Do you think they're going up? No, they're coming down. They're following the major index. This is why if you do not stack probabilities, you're in a world of hurt. Okay, what about the Russell 2000? We can see that this month, the Russell 2000 was following the negative normalized price path. It diverged a lot because the VIX just went absolutely nuts. That was not normal price action on the VIX, not by any stretch of the imagination. We know that the VIX bottomed here, junk bonds bottomed on the 13th. And then what did we see? We saw that actually by the 25th, we had a pretty much a topping of the Russell 2000 and it started to come down. Now, what does that mean to us? The VIX is coming up. The purpose of our community is to help people think from an institutional grade level and get away from retail. Retail thinking will absolutely decimate your financial future. You cannot think retail if you're going to survive. The problem is that people just don't teach how to think from an institutional perspective. As a finance degree graduate and a person that spent nearly 40 years inside the markets, I share this knowledge because I had a life-threatening illness and I was given literally 3 months to live. But 1 month before my brain died, I was diagnosed with a very aggressive brain cancer. So I thought, what the hell, share the secrets behind the closed doors. And if you want to get secrets each and every day, you're going to see something that's not like any other channel. And if you know other people that could benefit from this knowledge, and who the hell wouldn't benefit from this knowledge? If they're inside financial markets, people need to know this. But Ken, it's not like what everybody else talks about. They just zoom into a price chart and talk about that and just only talk about one particular thing. Okay, well, of course, people do that. But if you actually want to know how to make money and keep it, which is the more important thing, this level of knowledge will serve you throughout your entire life. You can see that as the VIX was moving, we've already gone through row 1 and row 2, even with the price parts. We see row 3 is following what the directional correlation momentum is inside row 1 and row 2. And the VIX is undoubtedly driving the bus. But don't forget, it's not the VIX that always drives the bus. Sometimes it's the DXY, sometimes it's dollar yen, sometimes it's the yield, sometimes it's oil. You can't just naturally make a split second decision. Oh, it's always the VIX. It's not. Okay, let's go deeper into the rabbit hole. MicroStrategy, which is just strategy now. What do we see here? On the 11th, it bottomed. What time did it top? Oh, ooh la la, the 25th. Surprise, surprise. How anything moves is structurally dependent, and I mentioned inside MicroStrategy there is a heck of a gap that we're witnessing around specific levels. All price movements are structurally based and structurally biased. You may think they're random, they are not. Again, a secret behind the institutional door. What about Tesla? Tesla was quite negative last month. We saw at the 11th the bottoming out. So Tesla is following the VIX. What about the 25th? It's following that too. Surprise, surprise, again. What about Apple? Apple bottomed out on the 13th, not the 11th. Apple is following junk bonds. What about the 25th? What do we see here? A degree of just consolidation, and now it's starting to kick in as the VIX kicked up. What about Microsoft? Microsoft, the 11th, the 13th. It's kind of a hybrid between the VIX and junk bonds. But what we can see up into the 25th, this is a gravitational pull. Always understand, it doesn't matter if it wobbles around for a couple of days. What matters is the general direction and momentum. What about Nvidia? We can see Nvidia is following the VIX. Look at this behavior. On the 17th, it kicked up big time. And what about the 25th? Was it a topping action? There was quite a degree of turbulence inside here, but this is actually a downtrend from that time. So what you can get is an overextension that needs to decay and get back into synchronization. This is normal as well. Again, one of those secrets hidden behind the institutional door. It can be a little overwhelming behind the institutional door, but you should just get used to it because it'll make you a fortune if you understand what's happening inside the markets. And the VIX and junk bonds move inversely to each other. And what we've seen inside row 1, the VIX and these row 2 ones are moving in directional correlation. Not perfect, but moving in terms of momentum. We've seen that momentum play out inside row 3, row 4. Now we primarily focus on the crypto market. Now why do we do all of this pre-analysis before we jump into crypto? Well, it's pretty obvious. Crypto is an exponential asset class. Exponential means something that a lot of people don't understand. Exponential is not linear. For example, this is linear growth. This is exponential growth. It's very different from each other. Now, what typically happens is the crypto will explode up and then implode down. That means that people inside the stock market just look at it and look at crypto and say, oh boy, that's way too volatile for me. How I look at it is a little bit different. Inside the stock market, you must use leverage because the movements are so damn tiny. They're like little pinpricks. You just can't do anything with them. But with the crypto market, it's like you're leveraged up already. So I do all my trades at spot because I used to be here, now I am here, because it pays. And one thing to note, Bitcoin and the crypto market are 24/7. The stock market isn't. If the markets are crashing down, guess what? You're locked in, you are screwed. If you want to level the playing field, you can see how the markets are weakening or improving. Looking at the crypto market, if you're not happy with things, you can make a decision and you don't have to wait for some arbitrary market opening time. 24/7 is a lifesaver. This is why I'm fully in on crypto. When I talk about crypto, I'm in, and I mean all in. Ken, I thought you're not supposed to do all in. Well, it depends on the asset class, doesn't it? But I'm not all into these guys, I'm all in on these guys. Because it's so damn profitable, that's why I'm there. Okay, now we understand row 1, 2, 3, and 4. But let's look at the key ones on row 5, Bitcoin and total crypto market cap. Unfortunately, a lot of retail people don't understand the intercorrelation and interconnection between the main markets, all those different rows, and the crypto market. And that is very, very dangerous to your profitability. Looking for this month, where did we see that Bitcoin bottomed out? It bottomed out on the 11th. What is Bitcoin following? You got it, it's following the VIX. But what about the 25th? Yeah, pretty much bottomed or pretty much topped out there, and we've been seeing negative price action. Okay, Ken, now it's getting really real. All right, so perhaps you're not investing or trading in Bitcoin. Perhaps you're not interested in crypto at all, but you should be, because this particular signal reflects back inside what the main markets are doing. Remember, 24/7 is a lot different than a really tiny trading window on the major exchanges. So what do we see here? What is this telling you? It's telling me, for example, that the VIX is starting to spike up. Just remember, last month we were looking at prices north of 100,000, but our negative price path was predicting prices around the $85,000 area. Last month, many people said it can never get down there. Well, it depends what the intercorrelation and interconnection does between charts. Intercorrelation and interconnection will give you one aspect of how the market moves, but it's actually structure that makes you money. I'll explain it exactly. Let's zoom into this area on Bitcoin right now. We can see that Bitcoin is currently 81,638. What these particular lines mean, and what are they called? They're called CTKS lines or CTKS levels. They're also known by the word SLs or Stanfield levels. They are the highest probability support and resistance lines that you can possibly draw on a chart. They are created through 2 levels of standard certification. They are absolutely the gold standard. Price is always moving between structural levels. If it can't get above a structural level, it has immediate negative structural attraction to a level below. If you get panic inside the market, especially when you get negative CTKS gaps, you can get overshoots of lower structural levels. But as you see, price is always moving in a wave, something that I always talk about. Institutional traders and investors know this. They make their money from wave-based trading. And you can too. I'll show you a trade on Pepe that I did literally 24 hours ago. So it was on a Sunday just before I took off. So I wasn't in the market for long, but one of the things that you can see at this structural level, just below 81,900, you can see that was a very important level for us to hold. We've structurally overshot it because we're in a negative CTKS gap. This means that the price can come down rather quickly, but it can also reverse rather quickly to the upside. Retail, unfortunately, is a light switch. Tell me if it's going down or it's going up. I can only tell you it's moving in a wave between structural levels. You must observe price in its natural environment. Stop thinking about price as something that you can crystal ball and start thinking about price like a wild animal, say a lion in the safari. You're just tracking that animal. When it gets up to a fence, the animal can either jump over it and go to the next fence, or the fence repels it. It's like an electric fence and it comes down to the fence below. What you will find, every single thing is structure. Directional correlation and directional momentum will give you an understanding of how patterns in charts are playing out, but it's only structure that helps you to prepare ahead of time. When we look at the entire crypto market bottomed out on the 11th, aka it's following the VIX. And where did it top out? On the 25th, aka it's following the VIX. And it's starting to come down. And when you look at it, you should be very aware that there are so many cut unders here that if the VIX continues to spike, we're coming down. But that's not a bad thing. In fact, the wave-based behavior, like a lot of people would say, oh, I wish I bought on the 11th so I could sell up there. Those people weren't even in the market. As soon as they see a couple of red days, they're scrambling for the exit. On the other side of the door, on the professional side, on the institutional side, we love red days. Not because we're shorting. In fact, the only strategy that I employ is to go long at spot. Now, what does this mean? When I see these negative red days, I'm paying a lot of attention to intercorrelation, interconnection, but especially structure. That's what you must be looking at too. Structure is your savior. If you don't know the structural levels, you're in a world of hurt because you won't see stuff like this. You just won't see it. Okay, let's go back and summarize. What we can see currently is row 1, the VIX is absolutely in control. There's some degree of correlation inside the major market indices with the bottoming out of junk as opposed to the topping out of the VIX. So just keep these different things in mind. They are very important, but it's literally a couple of days apart, +1, +2 days. And we've seen on the 25th, everything just got back into synchronization with the VIX. So if you're wondering what's happening to Doge or Solana or ADA or Ethereum or Bitcoin, the answer is up here from row 1 down to row 4. This is Pepe's price action recently, and you can see what Pepe's done as an investor is to bleed investors out. But traders are very different. Traders are into timing. Timing is vitally important. If you cannot time the market, you can't make profit on these price waves. And of course it depends where you live and what time zone you're in. You're not awake 24 hours a day and you don't need to be. In market conditions like we find ourselves in right now, you must be cautious. Guarding your account value is wildly important. Now I'll just quickly show you the trades that I made on Pepe. Retail trade perfection is a very, very dangerous thing to have. RTP just describes the concept that if you're playing baseball, you've got to hit a home run. If you're boxing, every punch has got to be a knockout. If you're playing golf, every time you strike the ball, it must be a hole-in-one. Institutional traders and investors think completely differently. They're not interested in holes-in-one, 3-point scores, anything like that. They hit singles. And it all depends on what the market can give you. Here you're seeing, just on Pepe, literally yesterday, What I did was just to get very small percentages, and you can notice here I had a 1p position size, and when I felt the market was turning against me, I just sold it out at that point. And sometimes the particular returns are not much. The way that I like to think about it, it's like you're in a restaurant and you're serving dishes up. If you could get a $41 dish, which is about a $60 Australian dish, hey, good on you. That's pretty cool. It's like all of these are your dishes that you put out inside your financial restaurant. If you think like that, it's a lot better. Now, across that particular time, and I wasn't realistically trading for long, I made nearly 2,000 Australian dollars. And when you look at these percentages, they're not much, but we know you don't have to make big percentages to make big percentages. This is just an illustration. If I was an investor, I would have been bleeding out on Pepe. But as a trader, I'm profiting. Now, Retail Trade Perfection says that there's one winner and one loser. That's not true at all. This is scarcity thinking and a complete and utter misunderstanding of how financial markets work. This masterclass gives you a very good concept. If you don't look through the row 1 down to the row 7, you're going to be in a world of hurt because you won't understand where things are moving. But let's just do one particular analysis on Doge and see if the VIX and junk, see if the major market indices, Bitcoin and total actually affected this world famous meme coin. Looking at Dogecoin, we saw last month that it followed the negative normalized price path. What about this month? It's been doing pretty much the same, but we know intercorrelation and interconnection are incredibly important. What happened on the 11th? That was when the VIX topped out. We can see that Doge bottomed out. What about the 25th? We saw that we had plus 1 day here on the 26th, and don't forget that the crypto market is 24/7, so plus and minus 1 day, fine. What have we seen here? That it's starting to pull back because the VIX is starting to go up. One thing that you realistically want to keep in mind is that when you look at charts, you must look at intercorrelation and interconnection first, but you must look at structure. Structure is the absolute king of everything. Structure is where smart money will buy and sell. Intercorrelation will just give you an idea where smart money is buying and selling. Just returning to Bitcoin, we saw that we had structural support here and lower levels of structural support. When it was just plummeting down, we knew this structure would be action because it is. It's not a brick wall. A lot of people think that structure is literally a brick wall. It's not. It's a gravitational area, so it can overshoot, especially if it's within a negative CTKS gap. Going halfway, midway through, between different levels is often a pretty good strategy, but you can see how much it's retraced. If we come back, confirm this as support, we're heading up here with PSA positive structural attraction to the $83,000 area. If we confirm a loss of support and an institution of, implementation of resistance, we're looking at a movement down, again to a lower structural level. Everything is structure. If you're sick of thinking from a retail perspective, please make sure that you pick up the free cheat sheet from CTKSmethod.org. The link is in the description of this video, and you'll find that it's a fantastic thing. When you understand the cheat sheet, you'll understand how markets intercorrelate and interconnect. So many people have said, "Oh, Ken, I just don't understand why the price is doing something and yet the charts are moving from the opposite, in the opposite direction." It's because momentum, intercorrelation, and structure are the only things that you realistically need to look at. I know a lot of people get into the news, and it's good to be aware. It's good to understand what's happening outside in the outside world. But remember, the charts always move first. Main Street catches on typically when it's too late. One of the key things is to understand when it's time to get out of something and when it's time to get in. Structure will tell you when it's time. These institutional secrets are incredibly helpful, and if you have loved ones or family members or friends that you want to share this video to, I would definitely encourage you to do so. Everybody needs to learn how to trade, and you saw with Pepe, you can make money in a down market going long at spot. It's not an extreme sport or anything like that. In fact, I'm highly risk averse. All you need to do is to time the market. And in the age of AI taking over everything and robotics, your jobs are not safe. Your children's jobs, your children's future is not safe either. Learning how to trade, I would believe, will become one of the most important things you could ever do for intergenerational security. If you like this kind of content, please subscribe to the channel. And there are a lot of free resources at CTKSmethod.org. Also, if you would like to learn how to use the cheat sheet more effectively, there are a lot of videos in here to help you out. And also there are some different trades that I've shared on YouTube. I would suggest if you can find 2 or 3 people that you could share this video to, it will completely change their lives. These are institutional secrets, and this masterclass will give people an understanding that is just not available anywhere else. Thanks for watching.